Are ready to discover a smart way to earn interest? Whether you're new to investing or looking to diversify your portfolio, understanding debt securities can be a game changer. These financial instruments offer a reliable way to grow your money with relatively low risk. Yay! Welcome to Debt Securities 101. In this chapter, we'll break down the essentials of bonds, treasury bills, and certificates of deposit, or CDs. By the end, you'll have a clear understanding of how these instruments work and how they can fit into your financial strategy. Debt securities are financial instruments where you lend money to an issuer in exchange for interest payments and the return of your principal. Essentially, you're acting as a lender, and the issuer could be a government, corporation, or financial institution. Common types include bonds, treasury bills, and certificates of deposit, also known as CDs. Each of these has its own characteristics and benefits. First up, let's dive into bonds. Bonds are long-term securities with fixed or variable interest rates. When you purchase a bond, you're essentially lending money to the issuer for a set period known as the bond's term. In return, the issuer agrees to pay you interest, typically on a semi-annual basis, and to return your principal at the end of the term. Think of them as IOUs from companies or governments promising to pay you back with interest. Bonds can be issued by various entities, including corporations, municipalities, and federal governments. The interest rate or coupon rate can be fixed or variable, and it compensates you for the risk of lending your money. Next, we have treasury bills or T-bills. These are short-term securities issued by the government, typically with maturities ranging from a few days to 1 year. These are short-term securities issued by the government. T-bills are sold at a discount to their face value, and you receive the full face value at maturity. The difference between the purchase price and the face value represents your interest earnings. T-bills are popular because they're considered very low risk. Since they are backed by the full faith and credit of the US government, the risk of default is extremely low. This makes them an attractive option for conservative investors looking for a safe place to park their money. Finally, there are certificates of deposit, or CDs. These are time deposits offered by banks with a fixed interest rate. When you invest in a CD, you agree to leave your money in the bank for a specified term, which can range from a few months to several years. These are time deposits offered by banks with a fixed interest rate. In return for locking up your money for the agreed term, the bank pays you interest, which is typically higher than what you would earn from a regular savings account. They're great for earning stable returns over a set period. CDs are a good choice for investors who want a guaranteed return and are willing to commit their funds for a specific period. However, it's important to note that withdrawing your money before the CD matures can result in penalties. When trading debt securities, consider interest rates and credit quality. The value of bonds, for example, is inversely related to interest rates. When interest rates rise, bond prices typically fall, and vice versa. Additionally, the credit quality of the issuer affects the risk and return of the security. Bonds generally rise in value when interest rates fall. This is because the fixed interest payments of existing bonds become more attractive compared to new bonds issued at higher rates. As a result, the price of existing bonds increases. T-bills are seen as low risk, and CDs offer fixed returns, making them stable options. Both T-bills and CDs are excellent choices for conservative investors who prioritize capital preservation and steady income over higher returns. To sum up, debt securities like bonds, T-bills, and CDs offer different ways to earn interest while lending your money. Each type has its own risk and return profile, making them suitable for different investment strategies and financial goals. Each type has unique features, so choose based on your risk tolerance and financial goals. Whether you're looking for long-term growth, short-term safety, or stable returns, there's a debt security that can meet your needs. Happy investing.